So we always tell folks the policies, they're not investments. People who come in and say, oh, it's a terrible investment. Guess what? I'll be the first to agree with you. It's not an investment. The reason that they're saying it's a bad investment is because of what you just said. It operates like an investment to a certain point. The more mature they get, you put in $1, you'll have $2 to $3 of increase in cash value in mature policies. And so they're looking at what's effectively a return on premium, which is not something you should be looking at. Granted, it bridges the gap between saving and investing. It sits in its own asset class. Another way to think of it is everyone's like, oh, well, a coin has two sides. No, the coin has three sides. The policy sits on the edge like a coin. You have the side of the borrower, you have the side of a builder. The policy is the center side, it's the actual edge of a coin. It sits in between saving and investing.
Welcome back to another episode of Wealthwise Banking. I'm Jason Patrick Sipple, and I'm here with my favorite, definitely my favorite co-host, Jeremy Lee Huggins. How you doing, Huggy Bear?
I'm doing great, man. So I'm ready to try this new episode out today. I thought that your idea was pretty fun, and I'm assuming this was inspired by your recent road trip up to Savannah, Georgia.
It was inspired by the road trip. When we road trip, we like to do trivia, and we usually like to do trivia that we know stuff about, because otherwise Connor just kills us unless it's stuff that's older for Patty and I, or Harry Potter trivia and stuff like that. But we like to do some trivia in the car. So.
All right. Well, let's get into it, man. So what are the rules? What are the ground rules for the day? How does the audience play along?
Yeah, well, that's the most important thing. We want the audience playing along. We want Jeremy and I are going to ask each other questions. We're going to give about a 3 to 5 second pause for you to answer, and then we're going to talk about the answer a little bit, and then we're going to go to the next question. So at the end, let's see if you can beat Jeremy and I when it comes to IBC trivia.
All right. That probably leads into question number one, doesn't it?
It sure does, Jeremy.
All right.
We're starting easy, folks. We're gonna warm you up so you feel pretty smart. Okay, Jeremy, let's start easy. Let's start with question number one. What does IBC stand for?
Uh, it stands for infinite banking concept.
Okay. That was pretty easy, right? I hope everybody in the car listening to us, all of our listeners, including Jeremy's mom, really enjoyed that. And this is coined by Nelson Nash, right? So I think we're off to a good start. We're one for one, Jeremy. How do you feel about that?
I feel pretty good. Nelson Nash, like you, like me, like many of the folks who end up practicing this, it came from his book, right? Becoming Your Own Banker, written back in 2000, I believe. So, wow, quarter of a decade or a quarter of a century ago. And so a lot of people have been doing this since then.
Yeah, it's a pretty well-known book with not enough copies sold yet, but hundreds of thousands of copies sold at this point. So number two is pretty easy too, Jeremy. We're gonna warm this up. We're gonna get harder as we go.
All right.
What type of life insurance policy is at the center of the infinite banking concept?
Well, if you read the book, Becoming Your Own Banker, the answer's in there as well. And it is a dividend paying whole life insurance product, right? So that's what we're looking for.
Well, Jeremy, I'm thinking that maybe you had the answers prior or something, because I was expecting you to say the good kind, the best kind, right? Not term, not universal, not variable, right? Just the IBC specifically around specially engineered dividend paying whole life from a mutually owned company. Pay attention, because our banter is probably going to give you some additional answers too. So.
Yeah. Yeah. And one of the key words there is mutual, right? So mutual is very key in that entire phrase. So it is a mouthful, but words have meaning.
Yeah, and sometimes we get tired of saying the words, Jeremy. At least I do personally, but I think, hey, we got to keep saying the words, because eventually it's like getting on the mat. That consistent, persistent repetition is what builds the memory, right? And builds that muscle memory.
Yeah.
Uh, Number three for you, Jeremy. You're doing pretty well so far, my friend. I'm pretty impressed.
All right.
I might throw in a curveball at some point, just so you know. So, true or false? When you take a policy loan against your cash value stops growing.
That Jason's going to be false. So your cash
What?
value is going to continue compounding as though you never touched it. The follow-up question should be why, though, right? Right? Like that's what really baffles people is like, oh, well, why? Why does that happen?
And Jeremy, is that the bonus question? I know the why. Can I give the answer?
Yeah, go ahead.
play along at home too. This is a bonus question. It's because you are actually borrowing against your cash value from the fund, the general fund of the insurance carrier from your partner. So you are, this fancy words, collateralizing and borrowing against like a line of credit.
That's it. And what happens if you never put that money back into the policy? Like if you're using it as a personal line of credit, what happens if you fail to repay yourself, fail to restock the cash reserves?
Well, one, we don't teach people to do that now, but if you didn't, and if you're asking me when I die, then you're going to pay off that loan from the death benefit before, and the rest will go to your beneficiaries.
Yeah. So basically, if you have $1 million protection on yourself and you take $100,000 from the cash value, the very next day you get hit by a bus, well, then your beneficiary, be a spouse, your kids, a church, foundation, charity, it's going to receive 900,000. So the death benefit will be reduced by the outstanding cash value that you took out. That's what's happening.
That's outstanding. Okay, Jeremy, number four, we're going to see if I can throw you a curveball here because we already kind of gave the answer previously to the intended question. So, number four is, Jeremy, what is the one guarantee in life?
Change. Nailed it.
You got it, brother. Hopefully, you at home got it, riding along, got it too, because Jeremy's been struggling with this one for a while, but he's got it now. We've got him trained.
It only took me almost 100 episodes, but I think I got it.
You got it now. And what would you say to anyone listening? Why do we talk about that so often, Jeremy?
Well, it's true. There is no guarantee in life other than change. We don't know what tomorrow's going to have in place for us. So the way that we like to do is just prepare, right? During times of peace, you prepare for war. Noah didn't build the ark in the middle of a rainstorm. So what do you do when you're basically preparing for the worst case scenario? You're also preparing for an actual guaranteed scenario, which is you will graduate, you will pass away. Well, what ends up happening, right? When we end up structuring this and use the cash value for opportunities, emergencies, urgencies, whatever, it also gives the opportunity for you to spend your retirement accounts and everything else down to zero and still leave behind a meaningful protection, death benefit to your family tax free. So I look at this as kind of like a both and strategy.
I love it, brother. I love it. That's why we are here together. We're sharing this passion for it. So now we're Jeremy, you're 4 for 4, man. This is better than we do when we interview the two truths and a lie for sure, right? I think this is our format, man.
All
Well,
right.
if you're at home playing along, let us know how you're doing. Let us know what questions you want to hear. But number five, Jeremy, is what does it mean to be a mutual insurance company and why does it matter for IBC?
Yeah, so mutual companies are owned by policy shareholders or policy owners, right? The contrast to that would be a stock company. Stock companies, think of like Apple, think of Tesla, right? So the profits of the mutual carrier are returned to the policy owners. I like to think of it basically as being a fractional owner of the company. I'm entitled to company profits by having an ownership stake in the actual mutual carrier, in the insurance carrier, and I got that by having a policy. So I in turn get dividends.
I love that fractional ownership of one of these companies that are all well over 100 years old and profitable every year. That's pretty cool. We are
Mhm.
fractional owners of multiple banking policies, huh, Jeremy? That's what we're saying.
Yeah, pretty much. And they're very, very solvent, right? Like my favorite carrier, been around since 1905, Comdex score of 96, A plus rating. So the fact that I get some sort of ownership of such a powerful legacy enterprise is pretty powerful.
Yeah, that's I always tell people, hey, the one that we have our family policies with has been profitable since 1877. Not a bad track record, right? So,
Nope. Nope. They're all pretty good. Those
yeah,
mutual
they're all
carriers is what you want to team up with.
Yep, the ones that support IBC too. That's an important fact, right? The ones you and I work with, they're all supporting IBC. And here's I'm getting a little bit harder now, Jeremy. I think you're
When
doing.
do I get to start asking you questions?
Well, since I'm reading the answers and looking at the answers, I feel kind of bad about letting. Yeah, go ahead. Want to switch? Ask me the questions. I know the
All right.
answers.
All right. Let me ask you a question. Let me think
Okay.
for a minute.
Okay.
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 All right. So when we have a lot of the policies, the people talk about this thing called a paid up additions rider.
Hmm.
All right. So we have the way that we structure it, and there's multiple products. So for those of you who don't know, when we build these policies, it's not just a single product that's going inside of it. It's multiple products that build a total an entire policy. One of those factors, those features, right? It's called a paid up additions rider. Jason, what is a paid up additions rider? And then elaborate a little bit on why it's important to engineer that into one of these IBC policies.
Wow, you give me the hard question right off the bat, huh?
Yeah, no, suck it, nerd.
So everybody playing along, I'm gonna tell you that the simple, like my last name, explanation is if you do this, like Jeremy likes to say, Jake from State Farm can't do this. If you get a regular off-the-shelf whole life policy, it's very valuable, but it's all base. It's all whole life. And you will have cash value, but it'll take a while to build it up. So what we do to engineer it properly for you is we're going to add a paid up addition rider. And it sounds exactly like the words. It's paid up, meaning it's done, and it's an addition. So you're adding, this is what drives high cash value. I like to look at this as like the gasoline to make the cash value available within that 30 days if you need it, Jeremy, or whenever you need it. That's what's driving the system to grow faster for the banking function, for the living functions, for what we teach people how to do.
Yep. All right, man. I'll count that as a positive. You won. All right, on that question. Next question. Ready?
Yeah, yeah, I'm
All right.
ready.
Let's let's think about the family bank system. All right. When we go through our framework, we talk about two different classes of people. We have people who are basically creators, people who are contributors. What are the opposites of that in the family bank system? Like what are the synonyms, I should say?
Hmm. The synonyms and Jeremy, this is something I believe that you might have kind of brought this to our world, which I love. But we talk about how most of Americans, not anybody listening, but most Americans are borrowers, and we're helping them move towards being builders.
Mhm. Yep.
What are you looking for?
Yep, that is what I was looking for.
Okay.
And so the borrowers is what more or less we're all trained to be. It's the financial system that we are given to go out and take on debt, to take on credit cards, to use traditional banking to make other people wealthy. But when you start building your own financial system, that's our transition from being a borrower into being a builder. And that builder, well, guess what? You're taking ownership, you're getting equity, and you're more involved in your actual financial process. So you can build your own family banking system through an infinite banking policy. Again, it's a both and strategy. The main thing is the mindset shift. It's from going from being a borrower, which you were trained to be, all of us were, I was, Jason was, right? And then transitioning into becoming a builder.
And that's a, by the way, that's an ongoing process. It's not like you decide once I'm a builder, you have the identity, and then you're just free of all the patterns and the years and years that you are living as a borrower.
Mhm.
Right, Jeremy? Things are going to pop up, and you have to be self-aware enough to realize, like, wait a minute, I'm currently thinking like a borrower again.
Mhm.
Let me think how I can be more proactive and have my money do more for me.
Yeah. How can I take ownership of this situation?
Yes.
Right.
100%.
All right. Here's another question. All right. We're talking about mechanics, and my favorite thing is really the IRS and trying to trying to figure out how to get over on the IRS because they've gotten over on us for so long. But they instituted us back in the 80s this little thing called the MEC rule. For starters, what is that? What is a MEC? And how do we structure around it when we're building out these IBC policies?
Quick question, Jeremy. Were you even born when this went in?
Yes, I was.
Okay, okay. I just wonder. Hey, I was just curious. Just
I was in diapers, but I was around.
okay, okay. So in 1988, they established, they're like, wait a minute, rich people are putting all their money into what? Whole life? Hold on, I need to get mine. And so they came up with Tamra, right, in 1988, and this tax and miscellaneous. Revenue Act created what's called a MEC. And people are always worried when they talk to me, Jeremy, about the MEC. The MEC, I'm going to answer wrong here intentionally. The MEC means a maximum efficient contract. That's what Jeremy and I are going to build you. We're going to build you contracts that you can use that go right up to this line the IRS created that have all these implications if you go over it and create a modified endowment contract, which basically means that your policy has just became a taxable event and is pretty much treated like a typical retirement plan or qualified plan.
Which in and of itself is pretty powerful when you think about it, right? So we always tell folks the policies, they're not investments. People who come in and say, oh, it's a terrible investment. Guess what? I'll be the first to agree with you. It's not an investment. The reason that they're saying it's a bad investment is because of what you just said. It operates like an investment to a certain point, right? The more mature they get, you put in a dollar, you'll have $2 to $3 of increase in cash value in mature policies. And so they're looking at what's effectively a return on premium, which is not something you should be looking at. Granted, it bridges the gap between saving and investing. It sits in its own asset class. Another way to think of it is everyone's like, oh, well, a coin has two sides. No, the coin has three sides. The policy
Hmm.
sits on the edge like a coin. You have the side of the borrower, you have the side of a builder. The policy is the center side, it's the actual edge of a coin. It sits in between saving and investing. So when people say it's a terrible investment, I'll be the first to agree with you. It's a fantastic savings vehicle. It's a fantastic asset that allows me to become my own banker, but it also has investment like properties. It's just not an investment.
I like that three sides of the coin, brother. That was good. That was good. I think I'm doing pretty good. I'm feeling pretty confident.
You're
Let's
doing all right. You're,
let's
you're doing all right. How about this one? You want a curveball?
yeah, let's do two more. Let's do two
All right.
more for the group.
All right. Here we go. What is the difference between cash value and death benefit in a whole life policy? And I want to ask this question specifically because we get this misinformation out there that when you die, the insurance company is going to take all your cash value. So what is the difference between cash value and death benefit?
Ooh, you're asking to be nuanced here. This man. Whew, how do you feel about this? Everyone in the car, everyone listening at home, everyone
You gave me
now?
some softballs. I'll give you that.
Yeah. So this one, all right. So both Jeremy are growing over the lifetime of the policy. Okay. They're connected to each other. But think of them as ledger items, I would say. Like one, your cash value until your death benefit is always going to be larger than your cash value until the end, until the last year of the contract, right? Depending on how long and when the contract was written.
They typically run for 100. Most of them, the ones that we build, are 121 years.
Yes.
So when
Yep.
you're 121 years old.
Yep. 121 years old, 121. And so that's at that point, your cash value is going to equal your death benefit. Up until that point, your cash value is kind of like a part of the death benefit, if you will. And they're two separate line items, but if you pass away and you have an outstanding balance that we talked about earlier, you're going to borrow or your death benefit's going to pay off the loan, right, to the carrier, that line of credit you took from the general fund, and then the rest goes to the beneficiary, which is why, again, your death benefit is higher than the cash value because there's still a net at risk to the insurance carrier.
Hmm. Yeah. And it's not, to Jason's point, when we talk about 121 years old, if you actually run the math all the way to your 121, that is when the cash value and the death benefit equal each other.
Yes.
Another way that I like to think about this, probably more conceptually, is the value of your home is what you're going to sell it for, right? Someone goes out there and buys a house, but the equity is what you built into it over time. When you go to sell your house, do you get the sales price, which is likely more than the equity in your home, or do you get the sales price and the equity? No, you're going to get just the sales price. You're not going to get the equity that you built years into. But when you go and use your house maybe as a HELOC, well, now you're borrowing against the asset. You're getting the cash out of the house, kind of in the same way you would at a policy loan. If I take a policy loan, it's basically taking a HELOC against the policy itself. The value is still going to be the sales price. The sales price of a policy will always exceed the equity in the policy, which is the cash value. The cash value is the equity that you built up over time. And it's not until you're 121 years old does the equity and the value equal one another.
That's
Did
a
I just make that too complex? Was that weird?
no. I actually thought that was a great explanation because you don't get the sales price plus the equity, right? And that's what people always ask them. Why don't I get the cash value? That's the question you're answering. The
Yeah.
other part that I think is really interesting is people, right? Because we're designing these for the banking function, for the living benefits, and driving cash value early on so you can use it for the things that you're going to finance in your life. The one thing that I've been showing people, Jeremy, and I haven't showed them as much lately, but when I'm reviewing someone's, approved illustration before we move forward and request issue of the contract, I like to take them out to that 121st year, right? Or 121, the last year on the contract, and show them that the death benefit does indeed, for the first time, equal the cash value, or the
Yeah.
cash value equals the death benefit. Because then I ask them, like, wait, if your death benefit when you pass away is $10 million dollars and you have $10 million dollars in cash, then wouldn't it make sense that you want a higher death benefit actually? Because at the end, it's always equal.
Yeah. And the cash value is always trying to catch up to that. It's
Yes.
always trying, and the longer you have it, the more mature, the faster it grows, the faster it catches up to that long-term death benefit. So the question is now, well, what happens when I live to be 121? Which could happen. We had a previous episode on people living longer, right?
You're going to
What?
give
So
this
what?
one away? I think we're going to have another trivia. Maybe we don't want to give this one away yet. Make him come
uh,
back. Make him hear it
All
later.
right. All right. Fair enough. Fair enough.
Okay, okay.
So
Final
do you want one
question.
more question?
I want one more question.
Okay.
Everyone playing along doesn't want 9 questions. I want to at least do a 10 questions today.
All right. 10 questions.
Okay.
All right. Nelson Nash in the book, Becoming Your Own Banker, he
Hmm.
described the banking function as the most important financial concept that most people never control. Again, why? Because most people are borrowers. They're told to borrow. In Nelson's model, approximately what percentage of every dollar you earn should pass through a banking function in your lifetime?
I was gonna say this is a bunk question, man. This one's hard.
It is hard. Yeah, this is getting into the weeds of the book.
Yeah, so this one, Nelson talked about, he also clarified. I'm gonna make a clarification point first. He said, hey, over, a period of time, typically 20 plus years, he suggests that every dollar that you earn is going to flow through your family banking system or your warehouses of wealth. Because in thought, every dollar that we earn already touches the bank and flows through a banking function at some point. So why wouldn't you flow every dollar through your system? Why wouldn't you control, basically, why wouldn't you want to control every dollar that flows through your banking system, through your life, through your own privatized system?
Yeah. His thesis for this is that you finance everything you buy, right? And that really comes back to opportunity cost. So either you're going to pay interest to someone else or you're going to give up interest that you could have otherwise earned. So that's the opportunity cost of look at things. Another way that's really simple is, well, buying a car. When I go to buy a car, I can either pay all cash, the
Mhm.
opportunity cost of which I lost the ability to earn interest on my money. I'm not paying them interest, but I also lost the ability to earn interest on that money. Well, the flip side to that, the other side of that coin that borrowers go to is, well, if I'm not going to pay all cash, then I'm going to finance it and I'm going to pay interest to someone else. Or we can go to that edge of the coin. We can control the banking system. We can implement the policy and we become our own banker, right? We can actually have both an asset, one where we can earn interest without giving up control and without paying other people interest.
The great explanation. I hope that everyone playing along enjoyed this, got something out of it, learned something, and that you did as well as Jeremy and myself, because we both got hundreds today, I feel like. Jeremy, is that true?
No, I would say maybe you got a 95%, but you
Okay,
also
okay.
like intentionally didn't define MEC properly. So I don't know I can give you 100% points on that, which makes me the winner of the day. You're the loser. I win.
Well, Jeremy, I am happy for you that you feel good about winning. And I'm going to give a bonus question here for those listening along. We have the same opportunity every time that we speak with you. And we say, hey, if you want to have the opportunity to talk to us, Jeremy, what do we tell people to do?
Go to wealthwisebanking.com. You can book an appointment there. You can email us. You can figure out how this fits in your life. It was fascinating, right? When I first learned about it, I like you thought it was too good to be true, and then I was like, holy smokes! There's a reason that people have been doing this for over 100 years, and the wealthy families, regardless of where they generated their wealth, why they always institute this asset class to maintain generational wealth. So if you want to keep, create, multiply, this is the asset that I found that bridges that gap between saving and investing.
That's it. And both assets. So as always, be blessed. Go book your call at wealthwisebanking.com, and Jeremy and I will see you in the next episode.
All right.
Thanks for joining us on Wealthwise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.